2024 has been a great year overall for the stock market, and in fact a lot of that strong performance also includes semiconductors, which have for the large part performed fairly well. And in today's episode we're going to focus on two semiconductor giants. We have Qualcomm and we're also going to take a look at Broadcom, both leaders in the industry, but which one out of the two is a better investment right now for investors, something we are going to cover in today's episode. Now, for those that don't know, and a bit of a background about Qualcomm, they're better known for their mobile chipsets, the wireless technology, and right now they are a global leader in 5G innovation, providing chips for smartphones and even automotive applications. In fact, Qualcomm's Snapdragon processors power many of the world's leading smartphones. And then we have Broadcom, on the other hand, a much more diversified business model, again a key player in the semiconductor space as well as the infrastructure software, but their products range from networking chips to enterprise storage, and they also generate a large portion of their revenue from the software business. So first let's start off with Qualcomm, and we do get a double buy rating from Seeking Alpha on Wall Street with a hold from Quant. This one right now is trading towards the lower end of the 52-week range. It has a fairly decent starting yield for a company in this industry at just over 2%, and a forward P, as we will come to see, lower than the sector average at 14.6. Over the last year, respectable performance, up 24%. Over the last 10 years, it is up around 129, and as we can see, it is down from the 52-week highs of around $231. Now, if we do the same comparison for Broadcom, we actually get a strong buy from Wall Street, a buy from Seeking Alpha, and whilst we do note a hold from Quant at 3.45, 3.5 would flip them into a buy. As we saw with Qualcomm, they were trading towards their 52-week lows. With Broadcom, we see the opposite, trading towards their 52-week highs. A lower starting yield at 1.24%, a much higher forward P at 35.15, but we also notice a phenomenally strong performance, outperforming the S&P over the last 12 months, up 86%. And massive outperformance of the S&P over the last 10 years, up 1,628%. So we have right now two major players in the semiconductor space, but their strategies and focus areas are both very different. As we said before, Qualcomm heavily tied to the smartphone market, whilst we saw Broadcom, in fact, they benefit from a broader range of industries, including the software business. Now we're going to check a few things. First, let's take a look at how they performed over the last 10 years. We'll break it down to first over the last year. Now this is total return, includes dividends reinvested. Qualcomm up 27%, but Broadcom up significantly better, up 88.42. When we expand the time horizon to the last 5 years, Qualcomm up 120%. Broadcom up much more at 539, and as we already saw earlier on, Qualcomm, whilst up very strongly at 206%, Broadcom massive outperformance, up 2,138. Now yes, we can't look at past performance to determine their future, but it is always interesting to see with companies we look at on the channel how they performed on a historical rate. But from what we can see, Broadcom significantly better than Qualcomm. Then we want to take a look at their growth grade. Now Qualcomm, they do get a D grade. What we do notice here, their revenue year on year, 9%, is better, although marginally, than the sector at 4.2. We get the forward growth anticipated at 8.2, whereas the sector median at 6, again looking marginally better, but one area that they do fall down quite significantly is the earnings per share expected over the next 3 to 5 years is anticipated to be around the 6.1%, where we can in fact see the sector median a lot better at 15.5, hence why we do get that very poor rating of D on the growth. Unlike Qualcomm though, Broadcom do get a fairly strong rating. They get a B, and we can see their revenue growth looking very good at 32%, as well as the forward-looking 22%, much better than the sector median that we did just take a look at. And when we look at the growth anticipated to the earnings per share, nearly at that 20% level, much better than the 15% from the sector. Therefore, in terms of the growth perspective, we can see Broadcom does look a lot stronger and a lot healthier than Qualcomm. We then move into their earnings, both past and future, 4 quarters each way. What we notice is green right across the board from Qualcomm. That essentially shows us that over the next 4 quarters, they are anticipating growth to the earnings per share, whilst also showing us that over the last 4 quarters, they have outperformed management targets. That is a 100% track record. We always like to see that on the historical forecasting accuracy. because then we look at the earnings per share expected over the next full year, September 26, 12.31, which will in turn lower the forward P to 13.27. If we look at the same for Broadcom, we get green right across the board. However, you will notice they are anticipating double-digit growth to the earnings per share over the next 4 quarters, and similarly 4 out of 4, 100% historical forecasting accuracy, with some nice growth anticipated over the next full year, October 2025, there in turn lowering the forward P to 27.54. Now, when we do take a look at Broadcom and their expectations moving forwards, what we have noticed when we've looked at this company in a bit of detail, that their growth comes from both the semiconductor space as well as the software, and they do have exposure to cloud computing, AI, as well as data center positions for the future. We also notice that their acquisition strategy is a key driver of growth and therefore allows it to enter into new markets, enhance its product offerings, as well as increasing that revenue streams that generates their top line. Then when we did take a look at Qualcomm, the growth is less than what we did see from Broadcom. One of the main reasons for this is their biggest growth driver is 5G. More devices will adopt 5G and therefore their revenue from their chipsets, the licensings, will in turn rise. However, they are also looking to expand into the automotive space as well, which can help with them offsetting their slower smartphone sales that they have noticed in the more recent quarters. Now, we want to take a look at each one. We're going to take a look not just at their dividend safety and some of the valuation, but we're also going to run through the metrics of some highlights of what we like and maybe some things that we would like to see a little bit better moving forwards from each one of the companies. What we will say though, before we do take a look, there are some risks we need to cover with each one. With Broadcom, notably, they do rely heavily on the smartphone market, and if that demand does start to weaken, then their whole top line will take a very large hit. And you also have to bear in mind they face competition from companies like MediaTek, which also operate in the mobile chipset space. Now, in terms of their dividend safety, we get a score of 80. We do notice, as we will come to show you, reasonable signals on both valuation metrics. Nice to see a 6.3% above inflationary increase to the dividend in March this year. And what this ultimately means, which was reaffirmed just a few weeks ago, that their dividend cut for this company is unlikely. Now, the key metrics, how did they perform in the 07-09 Great Recession? Well, they increased the dividend. They had above average growth, -7% versus the S&P's -12%, and they also massively outperformed the S&P, -21, with the S&P's return -55. Now, looking at Broadcom and also mentioning one or two risks, one of the issues with this company, while they are diversified, they are exposed to acquisition risk. For example, they have been doing a lot of aggressive acquisitions, and this could backfire if the integration doesn't go smoothly. And you also have to bear in mind regulatory scrutiny, which is another hurdle, especially with the size of this company and their market influence. Now, dividend safety score, we have 67, a double overvaluation signal, which we will discuss. And we also want to say very poor increase to the dividend at 1% in September, well below the inflationary target. Now, this was reaffirmed. It will be safe, as we saw pretty much the same statement that we did get from Qualcomm. And when we do look at those key metrics, well, they didn't pay a dividend during the last recession, no comparative data, and we note they pretty much had average growth at around -12.7%. Then moving back to Qualcomm, we can in fact see 6% increase over the last 5 years to the dividend, 15% over the last 20, very attractive to note, especially remembering that they do pay a higher dividend yield than what we did get to see from Broadcom. 21% years in terms of consecutive increases, 4 years away from becoming a dividend aristocrat. And when we do take a look at the valuation based on the forward PE, and we do zoom into over the last 12 months, remember the blue tunnel is the expected fair price. Right now, it sits right at the lower end, indicating reasonable valuation / slight undervaluation. But as always, we're going to run both of them in our valuation model, so we won't conclude on any of these just yet. Dividend yield theory, remember that tells us a company is undervalued when the current yield sits above the 5-year average. Not far off the 2.15, so that is a reasonable signal. And the same to be said for the forward P, not too far off, 14.5 versus 15.8. So you could argue a little bit of undervaluation, but we do notice it does trade at a massive discount to the information technology sector as a whole, 27, with Qualcomm coming in at 14.5. Moving back to AVGO, we get 19% increase to the dividend over the last 5 years, and whilst Qualcomm was very strong, Broadcom's is higher at 36% year on year over the last 10, but they've been increasing those dividends for a less amount of years, coming in at 13. Then we get to the valuation model. When we do zoom into over the last 12 months, you can see pretty much all of 2024, this has been trading at a severe overvaluation, well above that blue expected fair price. And that is also mirrored when we look at both dividend yield theory, with the yield right now significantly lower than 2.96, and the same to be said for the forward P, 29.2, well above the 5-year rolling of 16.5. We do also note it is trading at a marginal premium at 29.3 above 27, something we actually saw the opposite for Qualcomm, where it is trading at a discount. We then move on to the free cash flow payout. As always on this channel, free cash flow over earnings, which is susceptible to manipulation by management through accounting. Below 50% is what we want to see for the industry. Remember, we have these targets, so we have faith they can continue to increase them at a very attractive rate. Looking good over the last few years, 33% in 2024, 33% expected over the next 12 months, so well below that threshold that we want to see as a maximum. Then we get to the free cash flow, consistent increases over the longer term. We don't get a lot of consistency, but we do note it is up 4 times over the last 10 years and expected to increase marginally over the next 12 months. Then we get to the sales growth. Bear in mind, a cyclical industry, we can see we want 3 to 7%. In fact, 3 to 4 is just to keep up in line with inflation. 2024 looking good, but we do note the year prior double-digit decrease to their top line. And when we do zoom out, look at it from a numerical perspective, we can see it is up from 25 billion in 2015 to 39 in 2024. Now, we do like to highlight these shares outstanding. We want companies that return excess cash through those share buybacks, something we have noted from Qualcomm over the last 10 years, but we do have to point out over the last 4 to 5 years, there has been relatively minimal movement, so we don't anticipate this to be a priority currently for management and their capital allocation. We then move on to ROIC, one of our favorite metrics, above 12%. Give us faith, management are able to effectively allocate their capital. We can see that looking very good over the longer term, nice 25% in 2024. And then we move to the margins. Operating side, well above the 16% year on year. No operating efficiencies, which is what we typically like to see. That is where the margin is increasing over the longer term, but nonetheless above the minimum threshold. And the same to be said for the free cash flow, looking very strong. 29% is very good in 2024. We then move on to the final one, the net debt to EBITDA, referencing the earnings before the interest, tax, depreciation, amortization. Below 1.5 is what we want to see. Remember, these numbers below are the number of years it would take the company to pay off all of their debt net of cash on hand, and correlates to dividend safety, balance sheet strength. 0.14, 0.13 expected over the next 12 months. Very good to report. Balance sheet does look to be strong. Dividend does look to be very safe, and no issues from this at all. We then do the same comparison for Broadcom, where we do notice it below 50% year on year. 34% over the next 12 months is very good to see. And on a free cash flow per share, nearly one of the most consistent we have seen actually on this channel in terms of growth over the last 10 years. Massive jump expected over the next 12 months. So interesting to see this, but also doesn't make us then shocked why this company does trade at a premium. These are the numbers we would expect. In terms of the sales growth, 32% on a trailing 12-month basis, so we are anticipating 2024 to be a very good year for this company, and we can see the phenomenal growth it has had from 2014 to 2023, and just look at that jump based on the trailing 12-month. One thing we don't like to see is actually the opposite of Qualcomm, even though they have been a bit stagnant in terms of the more recent share buybacks. But what we do notice, even though they have diluted your position over the longer term, you really wouldn't care given how strong this company has performed and the massive outperformance of the S&P over the last 10 years. ROIC looking very strong, as we would expect from this company given their metrics, given the valuation, and we don't get massive amounts of operating efficiency over the longer term. Lots of inconsistency. It has dropped on the trailing 12 month. Main thing is though, it is above that minimum we want to see. And free cash flow, actually maybe one of the best we've seen on this channel, 50% over the last 4 years. Very strong numbers, especially if they can continue with this over the foreseeable future. Now, the net debt to EBITDA not looking as attractive as we would want to see. Qualcomm looking significantly better. What we do notice, massive jump on a trailing 12 month, and over the next 12 months it is anticipated to come down, but no surprises why we got a much better score on the dividend safety for Qualcomm, and if we had to have a score for the balance sheet, well, Qualcomm would also look a lot better. Now, before we jump into our own valuation, we want to let you know we have released our latest free weekly article. We run through 2 cheap stocks that have gone under the radar, and we release one every single Monday morning to your inbox where we talk about severely undervalued stocks that deserve your attention, as well as what's gone in the market over the last few days. So if you click below, you can sign up and start reading straight away, where you'll also be able to grab a copy of 28 undervalued dividend stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, a recently released copy of 29 undervalued dividend stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. So let's jump into the valuation for Qualcomm first. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the intrinsic value today at $224, we'll just run through very quickly how we got this, ultimately the average of these four models. We have Graham's valuation, the stock ticker symbol, the EPS, long-term growth rate, AAA corporate bond yield, which gives us an intrinsic value showing overvaluation. Bear in mind, we're not looking at any one of these models in isolation. We then have the multiples valuation model, companies in a similar sector and size, average P multiplied by the EPS of Qualcomm to give us an intrinsic value. And then we move on to essentially the dividend discount model. Average growth rate 6.5%. We've gone a little bit lower. Again, another undervaluation, 2 for 1. And then we have the discounted cash flow model, the free cash flow year on year. Average growth at 24. We have gone a lot lower at 8. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. And as we can see here, our third undervaluation signal. On average, $224. What we like to do on this channel is start off with a 10% MOS, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, we'll buy up to $201 in today's episode. Then we keep going till it's near the current trading price. And what we can see, if you're buying this around $157, you're getting a 30% MOS. Right now, though, we see it between 25 to 30%. In fact, 25% margin of safety up to $168. Wall Street themselves, very bullish, $210 price target. They see upside of 30% over the next 12 months. We then move on to Broadcom, where we have an intrinsic value of $166. Now, we only have one model that we are using for this company. Given it is very fast growing, it would be unreasonable to use the other 3. It would skew this very, very significantly. And therefore, what we have done, as you can see here, similar free cash flow year on year, average growth a lot higher at 48%, but today we've gone for 15% moving forwards, which is our medium rate. Now, you can argue it should be higher, and full transparency, we will just show you at the 10% rate, this would be $112, downside of 34%, and at 20% we can see $240, upside of 41. Remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Broadcom, Qualcomm, or any others. So we take the 15% rate through, and as you can see right now, we do believe this company at around $170 is trading around its fair value. Therefore, there is no margin of safety. But if you want to see at 10% a buy at 149, at 15% around 141, and at the 20% point around $132. So in conclusion, we see Broadcom trading near its fair price, with Wall Street hitting around $200 as their price target over the next year, where they see upside of 18%. Do give us your thoughts below, although what we would consider between the two companies, if you're looking particularly for a growth play which is tied into 5G as well as other emerging technologies, then you could consider Qualcomm. It does look to be undervalued and does also have some significant potential in new markets, for example, like the automotive space that we spoke about earlier. But then if you're someone who prefers a more stable, diversified company, strong dividends, exposure to infrastructure as well, then Broadcom could be the better choice. Just bear in mind though, from a valuation perspective, as we saw, Qualcomm does, in our opinion, look to be undervalued, whereas Broadcom does look to be trading right around its fair price. As always, if you did enjoy the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below, grab those spreadsheets, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.